So let's say you want to become a millionaire, but you want to do it in the easiest, most passive way possible. I mean, who doesn't? Where do you start? You've probably already seen online that if you had invested in Bitcoin 10 years ago or Tesla 10 years ago, you'd already be a millionaire right now. And it all just seems rather frustrating, especially if you're new to this whole investing thing, the whole investment world. Buying index funds, stocks, bonds could all seem a bit daunting. And on top of this, when you then try and look into the whole world of investing, you get all these terms thrown around like 401ks and Roth IRAs in the US and ISAs and leases in the UK. And when that all seems complicated enough and you finally pluck the courage to start investing, the anxiety sets in. The mindset of investing is risky and you don't want to lose all your money starts to set in. So in light of all this, this video offers an overview of what is probably the best, safest and easiest long-term investment strategy out there for most people. And that, my friends, is investing in index funds. And better yet, it needs very little work and practically no skill, and yet it generates some of the best consistent returns out there. In fact, this strategy has outperformed over 99% of individual investors and over 90% of professional fund managers over the last 15 years. Oh, sounds too good to be true, doesn't it? Well, by the end of this video, you won't think so, and you'll understand exactly what an index fund is, how it works, and how you can set this up for yourself in a matter of minutes to be on your way to making millions. But before I go on, I want to make clear that this video isn't sponsored. I try and make genuine, unbiased content. And so can I ask, if you enjoy any of this video and topics, make sure to softly tap the like button below. It helps me and the channel more than you know. Before I explain what index funds are, let's start with some advice from a billionaire. Jeff Bezos once asked Warren Buffett, "You are the second richest man in the world, and yet you have the simplest investment thesis. How come others don't follow this?" To which Warren Buffett replied, "Because no one wants to get rich slowly." So what did Warren mean by his answer? Well, did you know that if you invested just $100 per month at a 10% return, in 45 years you would have over $1 million, which, to be honest, when I first heard this, I didn't believe it. So here are the calculations to help you get your head around it if you need to. This is what Warren meant by his answer to Jeff Bezos. It is really, really hard to get rich quickly, to get rich in a month or a year, but it is actually really, really easy to get rich slowly, and by far the easiest and safest way to make about 10% a year investing is through index funds. So what are index funds? Well, imagine you have a big box of chocolates, but rather than that box having identical types of chocolates in it, you want to make sure you have a variety of different kinds of chocolate available in that box. That's kind of like what an index fund does. But instead of chocolates, it's with stocks or companies. So let's say there's a list of the 500 biggest publicly traded companies in the US. That actually exists. It's called the S&P 500. The index fund would try to buy a little bit of stock from each of those 500 companies, just like you would try and get a little bit of each type of chocolate in your box of chocolates. So instead of you doing all the buying and managing of this yourself, you can put your money into the index fund. Essentially, it's like you buying a box of chocolates, and they'll take care of it all for you. And whenever those companies make money or grow, your investment in the index fund grows too. So before you say that sounds expensive, it isn't. So if you want to buy the 500 biggest publicly traded companies in the US, you can for the very affordable price of £76 or about $96. Since index funds are set up to follow lists, not trying to pick and predict which companies will do the best, they don't need a lot of people making decisions, which means they don't cost as much money to run. That's why they're usually cheaper for people to invest in compared to other types of funds. So it's like having a box of chocolates that's always getting bigger as more chocolates get added to it, and you don't have to worry about which chocolates to pick or how much they cost. You just sit back and watch your box grow. The great thing about index funds is you can buy into pretty much any market. You can buy a cross-section of the biggest companies in the UK, no problem. That will cost you £33 or about $42. Or what about a cross-section of all the public companies across the world? No problem. That will cost you £97 or about $123. It is an easy way to spread your eggs across many baskets rather than having all your eggs in one basket. So this all seems pretty straightforward, but how does this guarantee your future? And also, why haven't you already tapped the like button below? Look, my personal philosophy to index fund investing is it makes an excellent plan B, or safety net in my life. In reality, none of us want our plan A to be getting rich slowly. In reality, we'd much rather have the cash today rather than have to wait 10, 20, 45 years for it. So investing for your long-term financial security does not mean you need to forget about your shorter-term hustle to building real wealth. Look at it as an insurance policy. So for me, my route to building wealth quickly has been to set up my businesses, to develop properties, and so far that has worked really, really well to building my wealth far quicker than I would have ever been able to do through investing in index funds. However, if I hadn't been successful through my businesses, investing in index funds passively would have made me a millionaire anyway. It is the ultimate safety net to making sure no matter what, you can become a millionaire by the time you retire. But let's uncover the lies, because I hear rubbish about investing all the time, which are just plain wrong. And these lies are literally stopping people like you making wealth, which just annoys the hell out of me. So number one, saving your money in a savings account is not saving. Your money is going down in value in a savings account because inflation is almost always higher than the interest rate the bank pays you. You are basically lending your money to the bank so they can make money off you by lending it to someone else. Number two, investing is for the rich is a complete lie. You don't have to hire a financial advisor or have thousands or millions of pounds to play with. You can buy index funds for less than a round of drinks and probably buy them quicker too. Number three, investing is time consuming. Again, complete rubbish, because over the last 15 years, index funds have outperformed over 90% of professional hedge fund managers that are spending all their time analysing the market. If anything, it's actually better to not overthink it. Invest little but often. Don't keep refreshing your screen to see if the price has gone up or down. Just forget about it for 10 years. And finally, number four, investing is risky. Now, you know what? You might have actually caught me out here. Yes, if you invested in the S&P 500 index today, you would have so far lost money. But wait a minute. If you invested 5 days ago, you would have actually made money. Or 1 month ago, you would have made 2.5%, or 6 months ago, you would have made almost 14%, or you know what, let's go crazy and look at 5 years ago. You would have made 85%. So yes, it's possible you could lose money investing in index funds, of course, but as you hold your investment longer and longer, it actually gets harder and harder to lose money, because the big advantage to investing in index funds is you are spreading your eggs across many, many different companies. You are basically investing in the US economy as a whole by investing in the S&P 500. And as we know, the house always wins if you give it enough time. So let's look at the advantages of index funds. Number one, the biggest advantage is it spreads your risk. So let's say you have over $1,000 to invest 5 years ago. If you had invested in the match group, which basically owns a big portion of the big online dating sites like Tinder, Match.com and others. You expect them to do well, right? You would have so far actually lost just over 65% of your money in the last 5 years. However, the Match Group is actually part of the S&P 500 index. It's one of those companies. So what effect has that had on the S&P 500? Well, it's actually still gone up 85% over the last 5 years, despite the fact the Match Group has dropped so much. So this is a major benefit. You are spreading your eggs across many, many baskets. Yes, on one hand, if you'd invested in Apple, also part of the S&P 500, you would have almost tripled your money over the last 5 years. But taking a spread of about 500 companies means if some go up, some go down, the average is very likely to go up overall. It saves you, me, having to try and predict which companies you think will do well and putting all your eggs in one basket. You can just spread your risk instead. Number two, index funds have very low fees. That's because these index funds are very easy to put together. You're not paying an expert to decide which companies to choose. Because of this, they are very simple to manage with very little costs. All those savings get passed to you. So with Vanguard, who I use, the average cost is about 0.2%, which is the complete opposite if you choose to invest in a mutual fund, for instance. A mutual fund is where they are basically employing professional stock pickers who buy and sell short shares over time to attempt to beat the market, to beat the index funds. However, all the additional fees this creates means that rather than paying 0.2% for an index fund through Vanguard, for instance, you could easily be paying 0.5% or even up above 2% for a mutual fund. When you consider the S&P 500 outperformed over 90% of these sorts of mutual funds over the last 15 years, all without the higher fees, for me personally, it makes the option of investing in index funds a no-brainer, because in 92% of situations, I would have made more money investing in the S&P 500 than investing in managed funds over the last 15 years, and paid far, far lower fees in the process on top. And finally, number three, diversification. Spreading your risk, spreading your eggs across many, many baskets is the absolute key to why buying index funds is so desirable. Like I mentioned earlier, you could buy the Match Group 5 years ago and end up losing 65% of your money. Or you get lucky and you could have invested in an Apple 5 years ago and almost tripled your money. Or you can buy the S&P 500, invest in about 500 of the largest companies in the US and make a solid 85% increase without any of the stress of having to pick anything, having to make any decisions. So look, investing isn't difficult, and you can do it today with little money by just visiting Vanguard or sites similar. If you want to build your wealth, subscribe to see more of me, and I'll see you up here.